Imagine owning your first house or your first investment property with less money than you think. Who said that you need 20%? You can actually buy a property with only 3.5% down. Today, Alberto is with us showing us how to do it with, of course, loans, because he's a mortgage loan originator. So if this is something that interests you, stay tuned, because the amount of value that we are about to provide to you is crazy. It's amazing. One of the podcasts that I've learned the most. So without further ado, if you like what you're watching, this is Carlos Gonzalez in the Surf Investor Podcast. And let's start. Let's do it. Alberto, thanks for being here, man.
Of course, man. Thank you for having me.
Appreciate it. So the first question that I ask every guest is how many transactions have they done in real estate? So what about you?
Are we talking about like personal or just in the business?
Just in the business, like how many transactions have you been involved with, let's say?
Okay. So, I mean, as you know, I'm a mortgage loan originator. So on the business side of things, right now for 2024, I think I'm in like 15, about 15.
Nice.
So far, year to date. I help my broker owner do a lot of his files, so we do like 2-3 a month right now. It's kind of where we're pacing at. Personal, I haven't bought any properties just yet, but we were talking about it before we started recording. I do plan on buying my first one by the end of 2024.
Nice.
So hopefully I'll add one to the scoreboard there by the end of the year.
Yes sir. So can you talk more a little bit about being a mortgage loan originator? Because the majority of the people that have been in the podcast, even though they might be in real estate too, they are doing different things, but I haven't had anyone in your specific area. So for those that don't know exactly what's that, can you explain a little bit more about
so I mean, mortgages and mortgage loan originator, essentially what you do is anything that has to do with mortgages, whether it's purchasing residential, commercial, land, whatever it is, fix and flips, all that good stuff, anything that you need to take a loan out for, that's where we come in. So, if it's out on the residential side, you want to put 3%, 5% down, that's what we're going to help you guys do. And that's pretty much what we do.
And what's the highest percentage of transactions about? And what I mean is that, are those residentials, commercials, or like what's the most thing that you're looking at?
I would say right now, like probably 90% is residential, just because it's the most common one, right? People are trying to buy their first home, investors like yourself are buying multiple units, stuff like that. Commercial comes every once in a while, but residential is definitely the bigger piece of the pie on like a day-to-day basis.
What's the difference in the requirements of buying a property that is, residential for a first-time home buyer versus buying something that is an investment? What's the difference in requirements?
So there's two big things. So the first one would be capital, right? So if you're buying like a primary residence, you can come in with, for example, FHA as little as 3.5% down, conventional 5% down. So they give you more, a bigger loan amount versus when you're talking about investing, and most of it, like if we're talking about a DSCR, it's 20% down minimum. Some places you can maybe get 15, but nonetheless, you're putting way more than a primary. So that's the biggest thing will be the capital. Second will be just the experience, so if you're for example DSCR, a lot of them ask for some kind of home experience of like having previous home ownership or rental history or whatever. So there are some options for first time investors, but the main thing is capital and experience.
Hey, do you want to get into real estate without the hassle of buying a house, doing the repairs, and then selling it back on the market? It's a lot of work, but I have an opportunity for you. Me, Carlos Gonzalez, I've done over 25 projects with my team where we buy, rehab, and sell this type of houses. We're South Florida. So if you want to learn how we do it, and if you want to invest with us and take part of the profits, you can text or call at 786-679-1408. That's my personal phone number. I'm gonna answer every text, every call that I receive. If you want to invest with us, you know where to reach me at. So nice. So let me put you a couple of different situations here.
Yeah.
So let's start with someone that hasn't bought a house, right? And they want to purchase their first house for them to live in there. So what are the requirements? What's the process? Like, imagine I'm that guy. So what would you tell that guy that it's required?
Yeah. So I mean, the main thing, right, they're going to look at the main thing is DTI, debt to income ratio, right?
Okay.
And essentially the DTI is they're going to get your monthly debts divided by your monthly income and take a percentage, right? So if we're talking about FHA, the max that your debt could be combined between car payments, credit cards, student loans, and the mortgage that you're applying for can be no more than 55% for FHA.
55?
Yeah, for FHA.
Okay.
So if we're talking about 6,000 income, you're looking at maybe, was it like 3,000 and some change is the max that your debt could be on a monthly basis.
So, sorry for interrupting you, but
Yeah, no, you're good.
let's say you make 6K per month, so your debt should not be more than 3,000.
Yeah, pretty much. Yeah.
And then that way you can qualify for a first-time homeowner, for an FHA loan.
For FHA, yeah. So 55% will be the max that you can go. So that's the first thing I look for when I'm talking to like a first-time home buyer. I try to figure out their finances, right? So on the credit side of things, FHA is super lenient, right? So you could go as low as 500 if you're putting 10% down. 580 if you're putting 3.5. So it's very lenient on the credit side of things. The most important part is that they have that, because a lot of people sometimes they have car payments are like 800, 900, even over 1,000.
Really?
I've seen 1,200. So it's
1,200.
Yeah, for like a pickup truck, I'm like, damn, okay, that makes it tough. But yeah, so those type of debts, you gotta make sure that all that is under 55%. That's like the main thing. And then apart from that is just the numbers. Do they have the funds to closing costs, down payment, all that stuff.
And is there any other loan option for a first-time home buyer besides FHA? Is there any other, or you just...
There is.
Yeah.
I mean, conventional, you can always go conventional, which it goes from 55 to 50 on the DTA side of things, on the DTI side of things. So it does drop a little bit, but they are more lenient when it comes to appraisals, the docs that they ask for and stuff like that. But I always recommend, if you can do it, if you have all your ducks in a row, FHA is probably your best bet as like a first-time home buyer. But, there's always conventional, and there's a few other programs out there, but those are like the main two.
Okay. And I mean, in that case, what's the difference between those two?
The main thing is just, so we're going to get a little bit technical here, right? But basically, there's a secondary market, right? So whenever you do a loan, the lender, the bank is doing your loan, but then they sell it on the secondary market, right? So essentially, the main difference is who's buying the loan in the background, right? So if it's an FHA, there is, certain government companies or government I guess you can say like entities that are buying the loans, and they have their own guidelines. So FHA has their own guideline, and then there's like the Freddie Mac and Fannie Mae. Yeah, Ginnie Mae. Okay, exactly. So they each have their own guidelines, and then basically depending on what route you go, you have to follow those guidelines so they can sell it on the back end. So that's like the biggest difference. It's just those, making sure you hit all that.
I see. What's your advice to someone that is trying to buy their first house? Like, I guess you will say have your finances in place, right? Like, what else would you say?
I would say the main thing is just focus on, if let's say, assuming your credit score is good, right? Above 580, assuming your credit score is fine, just focus on keeping the debts really low. I would love to say, get more income, but that's easier said than done, Not everyone can do that. So just focus on lowering the debts. If you have a car payment, try to either refinance to lower it or just pay it off completely. Keep your credit card utilization or balance down, all that good stuff to just keep the debts low, because that gives you more room for the mortgage to come in and gives you more purchasing power. Because if from the 55%, if 50 of it is car payments, credit card, that means you only have 5% to work with. But if you take care of all that, then now you have way more to work with on the purchasing power. And it helps you, go from buying a condo to being able to buy a single family house or, whatever, So that's the main thing, and focus on your debts.
Exactly. And right now, interest rates are up, right? Or at least more than a couple of months ago, whatever. And there's a lot of people that might, let's say they are waiting to buy, right?
Yeah.
Or they're just scared, or they don't want to buy anything right now because of the interest rates, right? Do you think that's justified? I mean, do you think that's fair, or do you think they should still buy even though interest rates are not that?
That's a great question. Everyone always asks me that, and I think it all just comes down to where you're at financially, right?
Okay.
So whenever someone says, how they say, date the rate, marry the house, it's very cliche, but what you should really focus on is like, does it make sense, right? Do the monthly payments make sense? Because the reality is, this is what's gonna happen, right? If the rates drop by, let's say, 1%, I think I read an article the other day that like if it drops by 1%, about like 4 million, home buyers are now purchase ready. So now if it drops by 1%, that house that was listed for 500, now you have 4 million people coming into the market. Instead of 500, you're looking at 540, 550, so it makes it way harder for you.
Exactly.
So that's like the main thing. So I'd say, it's always the right time is always now if you can afford it. I'm not going to force you to make, whatever. But if your payment is 3,500 or 4,000 and it makes sense for you financially, then nothing is holding you back. If the rates drop, you refinance, and now your 4,000 went down to 3,500 or whatever, even better for you, right? But at least you're in the house.
Exactly.
But yeah, that's like, I always say, if you can afford the monthly payments, then just go for it.
Exactly. And I want to like double down on what you just said, because people forget that, let's say you're looking at this house, which is $500,000, and you don't want to buy because interest rates are very high. But if they go lower, then more people are going to try and buy the house. So the house, you will need to buy it at like 550. So now you're buying the house at $50,000 more, even with a lower interest rate. But if you think about it on the long term, you are actually losing money.
Yeah.
So if you're ready to buy it, then buy it, right? And even in a market like Miami, the houses are appreciating faster than in other places.
Yep.
So maybe you buy at 500, and then I don't know, like couple years from now, it's gonna be 550, 600. So now you're actually making money.
Yeah.
But it's just like, if you can afford it, then just jump into the house, right?
Pretty much, yeah. I mean, that's why I always tell people, and then, like, for example, like you were saying, the houses appreciate here. So you could come in at 500, within a year or two, you're already back to, you made all the money that you had. And if the rates are down, then you refinance, and it's all rainbows and smiles,
Exactly.
But I always tell people, like, if you can afford the monthly payment, just go for it. You could wait for rates to drop, but that's gonna be a tough one when they do.
Exactly.
Which hopefully they do soon.
Hopefully, right?
Yeah.
So I guess you talk to a lot of people daily, right? That they're applying. So what are the common misconceptions that people have when they are applying for a loan or they want to buy a property? What do you think are like most of the common misconceptions?
I'd say I'll give you 3. So the first one is the 20%, right? A lot of people think you need to put 20% down to purchase a home. And I get why that misconception exists, is because of PMI, right? So for example, if you're doing conventional and you put 20% down, you don't have to pay, PMI, which is private mortgage insurance, right? So that saves you a couple $100 here and there. But the reality is you don't need 20%. We just spoke about you could go as low as 3.5%, 5%. So the biggest misconception is that 20% rule that people think that you need. The second thing will be your credit score. So a lot of people think you need either 700 plus or 650 plus. If we're talking about FHA and you have 10% down, you could go as low as 500. And that's 500 is really, really low, like in the grander scheme of things. So it's like you have a lot of room to play with. And then last but not least, when it comes to the misconception, I'll say is your credit pools. So when you're applying for a pre-approval, a lot of people, and some banks do this, but a lot of people think that you need to get a hard credit pool just to figure out, how much you can afford, what your monthly payments are going to be, that type of stuff. And the reality is you could do a soft pool, right? Some banks do a credit pool, a hard credit pool. And I mean, in that case, that's why brokers are better, right? That's, but essentially, we do a soft pool. It doesn't affect your score. It's free of cost. And we get to see everything that's on your credit report. We get an actual, accurate idea of what we're working with, and we're able to pre-approve you. So there's really no harm in reaching out to a lender and saying, hey, I want to buy next month, in the next 6 months, whatever, and get pre-approved, because no cost. It's not going to hurt your credit, and then it's better to know than being the unknown.
Exactly. That makes sense. And is there any difference when someone is working for an employer rather than self-employed in terms of applying for a loan? Is there a difference?
There is. Yeah, there's definitely a difference. The biggest thing is how your taxes are set up, right?
Okay.
So if you're a W-2, your life is so much easier, right? Because you get your W-2 statement, you do your taxes. You probably don't have much write-offs, so it's whatever it is, right? On the self-employed side of things, we're talking about 1099. You probably write off your car, any business expenses, marketing, whatever your business is, right? You probably write off a lot of things. So they're going to look at your net. right? Not your gross. So if you gross 100,000, but you write everything off, and now your net is 50,000, they're gonna look at your 50,000. That's if we go FHA or conventional, those first-time home buyer programs. There are options, right, which is called non-QM, and those non-QM loans, there's like 1099 loan or tax statement only loan, that type of stuff, that lets you go based off like if it's a 1099 loan. It's just they're gonna look at your 1099. If it says 100, they go with 100. The only thing is that with those, but with those loans, it's not like first-time buyer type of loans. So it's like 10%, 15% down. The rates are a little bit higher.
So you can't get that loan if you are not first-time.
You could. It's just you're not gonna get the benefits of first-time home buyers, like a low down payment, better rates. Because right now, if you do FHA, right now, I mean, the rates are actually pretty good. So right now, it's like in the mid-5s. You do nice. FHA, 3.5 down. If you go the 1099, you're looking at somewhere in the 6s, mid to high 6s. You're looking at 10, 15% down. So it's not the best option for first-time buyers, but for business owners, it's definitely the best option, right? Because the majority, like you, me, we're all 1099. We write off a lot of things. So, that's probably your thing. But that's the biggest difference, the way you structure your taxes and how much you write off.
Makes sense. And then, so back to the scenarios that I was pointing out at the beginning. We already talked about someone that is buying their homes for the first time. And what about someone that is investing, right? I guess there's different ways of investing. So let's start with the one that I know about, fix and flipping. So can you get a loan to fix and flip a house, which is buying a house, rehab it, and then sell it for a profit? Can you get a loan for that?
Yeah, absolutely. So these type of loans will fall under like a different umbrella. So it's not going to be your FHAs or conventional, none of that stuff. It's basically like hard money loans, right? So you're going to go to these lenders that are more smaller, they have their own guidelines. It's very like niche. And, they're going to look at your deal and they'll tell you, we can do it or we cannot do it. Obviously, the rates for these are a lot higher, right? Because these are short-term loans. So they're going to say, Carlos, we'll give you, if you need $200,000 to buy, 150 for the property and 50 for the rehab, we'll give you the 200, and, loan to value. Usually they go up to like 80, right? So you got to put a little bit down, and then they'll give you the money, and it's usually like a year, sometimes 2 years. So you can fix the property and then just pay it back, sell it, and then you keep the profits. So that's how, you can go about it, those type of hard money loans.
Exactly. I have experience with those type of loans, and to put it in perspective, because a lot of people think that in order to fix and flip, you need like all the cash, right?
Yeah.
So an example that I actually have done, right? There's a property that we were gonna put, let's say if it was cash, it was like 300 plus like 60. It was a 360,000 investment. And then we were gonna sell it at 500. And let's say the profit was 80. In this case, right? You put 360,000 and then you get back 80. But with a hard money loan, we put like 60K, and then because we had to pay interest rate for the lender, now our profit was 60K. So it was 100% cash on cash return with the hard money loan versus I don't know, like I'm not gonna do the complete math here, but it was like a 30% cash on cash return.
Right.
So my point is that with a hard money loan, you're able to actually fix and flip with less money up front. And yes, maybe you're gonna do less profit, but you put less money, and at the end it's about the cash on cash return, like how much cash you put into it and how much you get back, right?
Yeah. So yeah, exactly. And a lot of people focus on interest rates, right? So like, when I quote someone's interested in a hard money loan or something, you're looking at anywhere between 10 to 13%, realistically. And then people are so used to like, 6, 5, for residential, they're like, oh, like that's really, really high. But, you're paying interest only, right? So you're paying interest only for that 1 year, 2 year. And at the end of the day, like you said, you're going to get this profit. If you do your numbers right, if you structure, you find the right deal, do everything properly, you're gonna make the money back and you're gonna make a profit. So it's, you got to think of ahead and not focus on the interest rate when it comes to those type of investments.
Exactly.
Yeah.
Exactly. Now, next scenario. Before asking and putting that scenario up front, is the process the same when you're buying a single family home versus a multifamily if it's for rent purposes? I mean, like you're buying a single family to rent it out, right? Is it the same buying a single family than a multifamily to rent it out when it comes to loan applications, etc.?
Yeah, I mean, so as far as it being it is, for the most part, and it just really depends on how we're gonna go it. So, for example, a big topic now is house hacking, right? So, for example, if you're doing multifamily, you can buy as like a primary, live in one unit, and then let's say you buy a quadplex, you rent the other 3 units. That's like you're buying a regular primary house. You could go up to 4 units doing FHA conventional. So you could buy a quadplex, triplex, duplex, putting 3.5% or 5% down, still live in one of the units and rent the other ones. That would be one strategy.
Nice.
The other one is buying it as like an investment completely, where it's like if you get a quadplex and you rent all 4, that would be the other one. You could do like DSCR, that type of loan. Overall, the process is the same. The only difference will be like if it's the documentation, right? The paperwork. So if it's DSCR, that's a no income, no debt. They're not gonna look at that stuff, right?
Because they're only looking at the property itself and how it's generating income.
Yeah,
let's say.
Yeah.
That's
So
on the DSCR.
That's DSCR. Yeah. So
Okay.
DSCR is debt service coverage ratio, and essentially they're gonna look at what the cash flow is, what the market value is, market rent is, and then go based off that versus the mortgage. So ideally, you want to be at a 1 ratio. So if the mortgage is 4,000 and you have 2 units, each one paying you 2,000, you're breaking even. That's good. You're at 1. Obviously, if you're higher, even better. But that's like the main. That's what they look at DSCR. So in those type of loans, they don't look at your income. They don't care how much you're making a year, because they're going to focus on how much the property is making. They're not going to look at your debts, so there's no DTI. They're going to look at your credit score, but they're not going to look at what's in your debts, and if you have a car payment, so your DTI is too high. They don't care about that, right? So the main thing is the cash flow, and that you have the down payment and the credit score for that type of loan.
And how do they calculate how much money they can give you on the loan or the monthly payments when it comes to DSCR? Like, how's that calculated exactly?
So as far as the structure of the mortgage payments, it's the same like any other mortgage, right? So it's a PITI, and then A if the property has it. So principal, interest, taxes, insurance, and then the A is association if it's like a condo and has HOAs or whatever. So principal and interest, that's depending on the loan value and the interest. Taxes, obviously whatever the property's taxes are, and then insurance. So that aspect is the same whether it's a primary or investment. The only difference is the interest, on investment will be a little bit higher, so maybe the numbers are higher. That's the only difference. As far as how they calculate the actual cash flow, is they do what's called a 1007, right? So that's it's an appraisal. It's called 1007, which is a market rent. And basically, they do comps. That's what they do, right? So they say, this unit 2-1, this square footage, in the area it's renting for 1,500, and an appraiser, it gives you that report, and then they will use that. And then they'll use that to like calculate, okay, 1,500 is higher than this, then you're good.
I see. Interesting.
Yeah.
Interesting. Realtors, you want to boost your commission while also helping your clients sell faster? Well, me and my team, we specialize on buying properties that are in distress. Properties that usually require a little bit more work to sell and a little bit more work to actually getting it to the closing table. We specialize in buying, rehab, and then selling these type of properties. And if you have a property like that, me and my team are looking for those every single day. If you have something like that, my phone number is 786-679-1408, and my Instagram is Carlos Gonzalez Investing. You can send me a DM, you can call me, you can text me. In any way possible, I'm gonna go ahead and try my best to help you out. So, motivo. So, what about when it's a bigger commercial property? Let's say like a, 10, 20 unit apartment complex. How's that different? I mean, is that something that you guys work with a lot, or not really?
We do commercials, not so much on the day-to-day, right? So the bread and butter is residential, because like I was saying earlier, that's usually what you come across more often. People try and buy their first home, investment property, whatever. But we do get commercials every once in a while. You are able to do DSCRs for like 10, 15 units. So you're still able to get that done. The process is a little bit different, just because, on the commercial side is not the same as, if you're doing it through a lender themselves, right? Because now we're talking about commercial lenders, so it's a little bit different process, but for the most part is it's generally the same stuff.
Nice. And how is it calculated? Like what are the requirements when
on
it
the
comes
commercial?
on the commercial side? I guess it's
I would say, well, so for example, if it's DSCR, it'll be the same, right? So if it's DSCR, it'll be the same as like, what we just spoke about. If it's, it just depends, right? If it's going to be business use, like if we're talking about purchasing a warehouse, they're going to look at, the main thing is experience. So they want
really?
to see, they want to see experience. They don't want.
That's the main thing, really?
Yeah,
Nice.
I mean, the main thing they want to see is experience, right? So they want to see that you've either purchased other commercial properties or you have other units. They want to see if it's for a business. They want to see how long the business has been going. Is it cash flowing? They want to, like, depending on the purpose of the property, that's the stuff that they want to see. And then as far as the loan, it just really depends. But generally, anything that has not, primary residence or residential, usually it's like 20% or more, So you're talking about like loan, 80% LTV, or less,
And then commercial loans are different because, for example, an FHA loan is a 30-year fix rate, right? But in commercial, it's different.
Yeah, commercial is different. They have different terms. I've seen 15. I think there's 40 as well. So there's different terms, on the commercial side, and that's like a whole different beast on its own,
Exactly.
Yeah.
Exactly. Have you seen any? I mean, how do you think your business has been affected with the interest rates? For example, something that we were talking about earlier. Have you been affected, would you say, or do you think that?
I definitely say, like, as far as like traction or traffic, right? That's like the biggest thing that affects you, right? Because like you were saying earlier, a lot of people are waiting on the sidelines, waiting for rates to drop. So that's the biggest thing that would affect us. Is just, it's a lot less people interested, and then the few that are interested, some of them aren't in the position to be able to purchase at let's say like a couple months ago when we were in the 7s, they're not in the position to purchase in the 7s or in the 6% rate. If it drops down to the 5s, now they can purchase. So a lot of it is purchasing power, and just the amount of people that are interested in actually purchasing. And also this market, South Florida, Miami, it's very hard to find properties that make sense number wise, because usually if your purchasing power is like under 300, you're looking at condos. If you're looking at condos, you have HOAs, you have the assessments, and these things are, some HOAs I'm seeing for like $500 on a $200,000 condo, and that really affects you, when it comes to qualifying. So
exactly,
that's a big thing as well.
So in terms of Miami right now, what do you think is a nice price point to be looking for houses? Would you say like $500,000 probably, right?
Yeah, somewhere around there.
400 to 500?
400, 500 for single family is probably where you're looking at, right? Like 300, you could maybe like a townhouse, right? But if you're looking for a single family, you're probably going to be starting at in the 400 plus, 450 plus. Anything under that is either townhouse or condo.
I see. Have you had any crazy experiences with any client, like applying or crazy expectations or things like that?
I mean, you encounter so many people in this job, right? So, there's a lot of different experiences between people wanting to, a lot of clients, they think that you're like the IRS or something. So they try to withhold things from you.
Oh, really?
And what they don't realize is that like we're here to help them, right? So it's like, lawyers, like just tell me the truth and, we'll work it out together. Like that type of stuff, So a lot of them are like, oh no, I don't want to show you the bank statement because then, if I show you this, you're going to ask about this deposit, whatever. And I'm like, listen, you show it to me, we'll figure it out, and then I'll see, because I don't care if I see it, right? We'll see it, we'll see what happens, and then we'll go from there, right? So I think the biggest thing is just getting that trust with people, right? Because a lot of them are just very wary of like giving you information, and that's usually where like the hiccups come in, So those are the people who are like, no, I want to give you, or like they get mad when you ask for bank statements or some kind of document. I'm like, I'm just doing my job, man.
Exactly.
I'm just trying to help you out.
Has it happened to you that there's people that they don't know that they actually qualify to buy a property, and then when you tell them like, hey, you're qualified for this, they're like, oh, really?
Yeah.
Has it happened to you?
It definitely does, yeah. So a lot of times they're just like, hey, I'm interested to see how much I qualify for. And you tell them, you're like, hey, you qualify for this amount. And they're like, oh, that's awesome. A lot of them don't know how much they qualify. And you kind of have to just explain, everything that we've talked about, DTI, your PITI, like all that. Explain it so they can understand how it works, and then make a decision from there. Sometimes, a lot of times, they realize that they don't qualify for as much as they thought. So they're looking at homes in the 500, 600 range, and I'm like, hey, you only qualify for 400, or 350, and then they have to change their perspective and start looking for something in that range. So it's important to reach out to your lender and see exactly how much you qualify for.
Exactly. I think that if you're buying a property for the first time, or even, I don't know, like second time, whatever, I think it makes a lot of sense to go first to to your lender in order to see how much you qualify for, and then you can start looking for houses. Will you say that's fair? Like
100%. I agree. I wish more people thought like that, but no, yeah, I 100% agree. I definitely think it just makes sense, right? Like you go figure out how much you can even afford before you even start shopping, because what's the point of reaching out to a realtor and say, hey, I want to buy a house, and then start going to homes or start looking at homes, and then you don't even qualify, right? So it just makes more sense to reach out to your lender, make sure you qualify and for how much, and then at that point you can look for a realtor or look for properties and have an idea of what you can do.
Exactly. It's like going shopping and don't know how much money you can spend, right?
Exactly.
Which I've done.
Exactly. I mean, just going window shopping, be like, oh, I like this. And you look at the price tag and you're like, yeah, never mind. I can't do this. Yeah, so yeah, 100%.
Yeah. I want to mention again, you mentioned house hacking, and I think that's a very, very important term to cover now because, I mean, it's a great tool to build wealth and to actually qualify for something because, correct me if I'm wrong, but I mean, let's start first with what house hacking is, right? So can you explain that?
Yeah. So house hacking is a term. But essentially what it means is that you are going to live in the property as a primary residence, but at the same time you're going to rent it out to tenants, right? So if it's a multi-family house, you could get a duplex, triplex, quadplex. You live in one of the units and then you rent the other ones to tenants, and then the income that you make from the rental will help you pay your mortgage. Either it will pay it completely or at least alleviate most of it, and then you're maybe paying just a little small percentage of it. I've seen it for single family homes as well, where someone would, for example, live in the master bedroom and rent out like the other 2 units, or if it has like a small ADU or like efficiency, they'll rent that out. So house hacking is just essentially living in the property and then renting it out to other tenants.
Exactly. And correct me if I'm wrong, but let's say you're buying a 4-plex, right? That you're gonna live in one unit, and then the other 3 units you can rent them for $3,000, let's say, each one. So that's $9,000 per month income. That $9,000 that qualifies as your income, when you apply for the loan, right?
Yeah, it does. So they'll use up to 75%.
Okay.
Right, so they won't use the full 9,000; they'll use 75% of it. Okay. But yeah, they'll still use that to qualify you, right? So they'll do the same thing like a 1007, like we spoke about earlier. They'll look at 1007 and say, okay, for those units, you'll make about this amount. So if it's 3,000 each, they'll take 75% of that, and they'll go into your qualifying like income.
Yeah. Interesting. So that's great because I mean that's a great option when you're looking for homes, right? Like you can just qualify for an FHA loan for 4-plex, live in one unit, the rest you rent them, and then you can just repeat the process, right?
Yeah, pretty much. So if you're doing like FHA and you live in one unit, after a year, you can move out and just go to like and buy another property. Usually if you're gonna keep as an FHA, for FHA guidelines, you need to either be a first-time home buyer or just not have any properties under FHA loan. So you can't have that property under FHA, for at least three years, like your name under title. So essentially, if you're gonna buy a second, you could do conventional, 5% down. But at the same time, you're going from 3.5% to 5% down. It's not a huge difference. And now you have, 4 units, 3 units, like you're starting your investment portfolio.
Exactly.
So I always tell like investors, like first-time investors, that are also first-time buyers, that's a really good stepping stone into the industry.
Exactly. Yeah, that makes a lot of sense. So now let's talk about the investing side. So what's your goal? You mentioned that you want to start investing, right? So what is your strategy to start investing?
So, I mean, I love real estate because there's like 1,000 ways to skin the cat, like they say, like there's so many ways to invest in real estate and so many strategies. People do wholesaling, fix and flips. People do like the house hacking. You can do like Section 8. There's so many strategies to go about it. And personally, for me, I think what I'm gonna start is probably investing out of state, just because the cost of entry is a lot less. So if we're talking about 20%, like a DSCR, 20% on a $500,000 house versus 20% on an $80,000-$90,000 house is hugely different, right? So I rather go out of state, purchase a couple of properties here and there, rental properties here and there. Probably gonna do long term. I really don't want to do short term like Airbnbs, or that's too much of a hassle. So long term rentals, either Section 8 or just regular rentals. That's probably gonna be my vehicle, my entry point to investing.
And another strategy that works a lot in the investing side is that when you use a hard money loan to fix and flip, you can then refinance, right?
Yeah.
And then that way you, instead of selling the house after you finish the renovations, you can refinance.
Yeah.
In that case, which loan will apply to refinance, or there's more than one?
You could just refinance it into like a regular loan, like a regular conventional loan at that point, you know, or if it's going to be an investment property, a DSCR, so you could do a regular DSCR at that point. So, you know, that's actually a very common strategy. I don't know if have you heard of BRRRR, like BR? Yeah. So, you know, buy, rent, rehab, refinance, repeat, you know.
Can you explain what that is? So if someone doesn't know what.
So BRRRR stands for buy, rent, or actually no, buy, rehab, rent, refinance, repeat, right? So you're going to buy a property, you're going to rehab it, then you're going to rent it out. At that point, you'll refinance it, and then you'll repeat. You know, at that point, especially if you do like a lot of value add. So if you buy a property for 100, put 50,000 in repairs, and now it's worth 200 on the refinance portion, you could probably pull out some equity if you have, and then use that equity to purchase the next property, and then just continue, you know, the repeat, you know, just keep going at that point.
Exactly. That's great. That's something that initially that's something that I wanted to do. Then I changed my strategy, but that's an awesome strategy. I have a friend that did that with multifamilies. So he was buying like fourplexes, triplex, duplex, ugly, you know, that needed work. He put the work into it, then he put tenants into it, and then refinance
it. Yeah, that's honestly at first that's what I wanted to do when I first got into it. Like Bigger Pockets, you know, Bigger Pockets, like Brandon Turner, he has the book called BRRRR. You know, I have that book in my house. So that's why. It's a great book. Yeah, it's a great book. So that's why initially got me into the industry, just wanting to do investment. So I've thought about that strategy. You know, I've thought about Section 8. Like, again, there's so many ways to go into it. So that's why I love real estate. You can get creative.
Yes, sir. Talking about books and resources, if someone wants to get into your business, you know, originating loans and everything, what books or what resources or podcasts would you recommend them to check out if they want to learn more?
If you want to learn more about mortgages, right, you know, I would say on the podcast side of things, Housing Wire, right? So there's Housing Wire Daily is like one of the biggest like journalism like websites out there for mortgages, real estate, all that stuff. So they have a great podcast with very good guests, you know, good data. TLOP, right? It's called the Loan Officer Podcast. That's a very great podcast as well. They talk about, you know, your day as a loan officer, but strategies, you know, stuff to look out for. And then as far as books, it's a combination of sales books, right? So, you know, how to influence friends and win, how to influence people and win friends?
How to win friends and influence
There you go. Yeah, that one. So yeah, I love that book. So that one's good. And then also there's a book called Rethink Everything You Know About Being a Modern Loan Officer, which goes into like social media and all that stuff. So there's a lot of, you know, sources out there. YouTube is your best friend, you know.
Nice. So I think the podcast is coming to an end, but is there anything else that you want to mention?
No, man. Well, I mean, I appreciate you bringing me out here, bro. You know, there's a lot of investors out there in the South Florida market, which is awesome. You know, I would say if anyone has any questions, you know, feel free to reach out. Like we spoke about it, you know, reach out to your lender first before reaching out to a realtor. 100%. Figure out what your plan is and then go from there. But yeah, I appreciate it.
Nice. How can people find you if someone wants to?
Yeah, so you can go on Instagram. You know, it's going to be my first name. It's Alberto, then Lens, Lends. That's my Instagram. I'm on Facebook, TikTok, all that good stuff, but all under the same username. But Instagram is like the main source.
Alberto Lens.
Yep.
Awesome. Well, sounds good, man. Thanks for being here.
Yeah, I appreciate it, man.
Thank you, man.
Take care, brother.